It was a pretty bleak earnings season.
Maybe results themselves were actually worse than investors thought.
$1 billion wiped off Spark's value.
Its profit fell by more than 3/4.
Fletcher Building's losses grew.
Those consumer confidence numbers, they're not really budging, are they?
Investors were not putting up with anything in terms of poor results.
Nicholas, some unhappy shareholders.
But amongst the doom and gloom, there were a few bright spots.
I think there is a bit of investor optimism that there is no new bad news.
But when will it actually get better? Welcome to the NBR Podcast. I'm your host, Simon Shepherd. As companies reported their half-year results, expectations were met and possibly exceeded on the downside. 38 companies listed on the NZX main board released their figures. 26 were flat or down. So, to take stock, as it were, we've got a panel of 2 analysts and the CEO of the Shareholders Association. But first, please don't take any of this as financial advice. You'd be crazy to follow anything I've done with my money. Having said that, let's dive in. Joining me now is Mohandeep Singh, Senior Research Analyst at Craig's Investment Partners, New Zealand Shareholders Association CEO Oliver Mander, and joining us via Zoom, Nikko Asset Management's Head of New Zealand Equities, Michael Sherrock. Thanks for your time, guys. The big question really is, what was the theme running through this reporting period? Mo, I'm going to go with you.
Yeah, I think for me it was probably that investors were not putting up with anything in terms of poor results.
Right.
That's probably what we saw, and we're probably a little bit harsh. You know, some of the share price movements I think we saw this time, a little bit like you see in Aussie. You know, you sort of see investors shooting from the hip. I think we saw a little bit of that in New Zealand. We knew the backward-looking results themselves were going to be a little bit poor, but it was the outlook statements everyone was focused on. I don't think they did enough to really woo anybody, and You saw a lot of share prices come off. I think maybe 2/3 of companies that reported saw their share price fall on the day of the result.
Right, Michael, let's go to you via Zoom. What did you think the theme was running through these reporting results?
Yeah, I think it was just a reflection of the weak economy that we've been through, and results themselves were actually worse than investors thought. Despite the economy being really bad looking backwards, the results were actually a touch worse and a touch more disappointing than investors thought, and we saw that through that share price move.
So they were quite harsh. Oliver, what did you think?
Yeah, look, just to back Michael up, I think the theme was that sort of weak New Zealand economy. I also thought you saw a bit of companies that were really clearing the decks of the past. So that ability to look forward, and you saw CEOs and chairs and boards take decisions to absolve themselves of past actions and actually say, okay, well, what's coming up in the future, and trying to get investors focused on that.
Right.
But I think, like Mo said, that wasn't always responded to in a very positive way. I think the other thing that really came out as a theme was a real clear focus, ongoing focus on cost management and capital efficiency. So companies are really focused on where they're putting capital in the portfolios that they're invested in.
Well, question about that. In your view, we'll start with you, Oliver, have companies been doing enough cost cutting given the dire straits of the economy?
I think there's some really mixed information about that. I mean, if you look at the sort of macro numbers, what's really coming out is that companies are hanging on to their staff, and maybe that's a reflection of a few years ago when they saw labour shortages, and they're really trying to hang on to the people that they've got.
Yeah, okay.
Possibly at a short-term cost to investors, possibly for the benefit of the long term.
Right.
But I think the other thing you are seeing is, some companies are really taking some specific action. And you can look at companies like Fletcher Building, who are actually, they delivered probably above their own expectations in terms of where they are on their cost reduction journey following that. The difficulties that they had during 2024.
Right. So, Michael, do you think companies reassured people by taking enough cost out?
Oh, look, I think they're doing what they can as quick as they can. It probably takes a bit longer than investors sort of want. You look at the likes of Spark, who I think investors were somewhat disappointed by the lack of cost out that came through the first half result. But it just does take time. You can't just rip cost out very quickly, and in response to slowing revenue, it just does take probably longer than investors would hope.
Okay, well, that's a lovely segue into our sort of next section of poor performances. Mo, let's talk Spark. How can we not talk Spark? I mean, shareholders really punished them. on that result.
Yeah, they did, and I think I think the latest downgrade was probably about 7% on the earnings level. The share price is down sort of 20, so that shows that there's more in there in terms of the market is a little bit disappointed. I think some of that is probably around the dividend now. Remember they coming into that result had cut their dividend, but probably not as much as the market was expecting, and now you're sort of in this awkward position again where you've cut your dividend, but the market thinks, geez, you're going to have a second swing of the bat and cut again. So that's why I think you saw a little bit more in terms of the share price, and like Michael said earlier, I don't think they've been very nimble in terms of that cost cutting, or just appreciating that the earth is moving from under their feet a little bit and not moving quickly enough to follow that. Clearly some of their competitors have been, and that's hurting them. So I think that's probably what investors want to see, is be a bit sharper and start moving a little bit quicker and show us what your strategy is to deal with the issues now.
Yeah, it was quite astonishing that the share price drop. We can't spend all time on Spark, so Oliver, let's pick out another poor performer.
Okay, well, what I'd like to pick out is Heartland Group.
Oh, Heartland Group, the bank.
The bank, and certainly their New Zealand banking operations. In particular, I mean, certainly they've done well on their Australian side, actually, by the sound of it. That integration is going well. But on the New Zealand bank, I think this is the real, what's come home to roost there. The chickens of the strategy laid a long time ago, and certainly in terms of the impairments that they've taken now in that New Zealand bank, and we still want to see some more accountability for that. The members of the Heartland Bank board, there's a couple that have been there since 2015, that was their strategy, they oversaw it. We think that from the New Zealand Bank board that there's some change that's required, just to really placate investors in terms of ensuring the group has the way going
10 years on the board is a long time.
It is, and certainly it looks like a long time now in the context of the strategy that appears to have failed.
Michael, do you have another standout poor performer you want to talk about, apart from Spark?
Yeah, well, I actually do want to spend another few seconds on Spark.
Okay, go.
I think. Yep. Yeah, I think investors just have lost confidence. It was I think the fourth downgrade in a row, and so investors really questioning where the business is going. Will they be able to deliver on their new guidance? Just a real lack of confidence in the business now.
Okay.
And so I guess other companies that may have disappointed or have disappointed, Sky City, a casualty of the economy. So visitation at the Auckland Casino down, I think 7%, and it's just anyone exposed to the economy, to the consumer, doing it tough.
Right. Let's talk Fletcher's. Mo, I mean, it was a $134 million loss. That was worse than the previous reporting, but the market seemed to like it. Now, as a layperson, explain that to me.
Yeah, look, I scratch my head at first as well, as the share price actually bounces on that. I think that's probably that there was no new bad news. It feels like that what they said 6 months ago was kind of what was coming true, and they expect a continuation of that throughout the next 6 months. So things haven't deteriorated any further. And if you look back over the history, and I'm talking very short history, last 18 months, 2 years, they've come out with sort of a goalpost, and then they've had to move that every time. So I think there was a little bit of that relief rally of, geez, okay, this time it feels like this is as bad as it's going to get. I don't think the light at the end of the tunnel is very close. It's probably another 12, 18 months away in terms of the property cycle, the construction cycle, but it does feel like things aren't deteriorating much more than what they talked about late last year. Interesting sector, though, because not only with Fletcher's, who said it was like the deepest downturn in recent history, bouncing along the bottom, and then we had Steel and Tube saying demand lowest since the 1990s, and Vulcan Steel, most difficult period, Oliver. That sector is really, it's not great.
No, it isn't. And look, we talk right at the front of this around that weak New Zealand economy and the cycle that we're in, and all of those companies are deeply exposed to that. I think it's ironic that in Fletcher's case, the one division that posted an increase was construction, which is, given the difficulties of the last decade, it's actually really interesting to see that. Okay. But I think Mo's right. I think there is a bit of investor optimism that there is no new bad news. That this is forming some sort of foundation for that company to move forward. Right. So that's probably very helpful.
Okay. Let's look at other sectors, Michael. I mean, I was looking at the energy sector. Meridian, $121 million loss, wants access to more water. Mercury had a $67 million loss. How would you summarise the energy sector from the reporting season?
Yeah, it's just a reflection of the low lake levels and the hydro part of their generation just doing it tough with lack of water, meaning that they've had to go elsewhere, buy energy from other areas, get access to coal. It's just a tough environment for generating energy at the moment.
Okay, all right. And another sector we should talk about. I think you mentioned. One of you mentioned Sky City because it's like a retail stock, but we've had the warehouse put out a forecast. So the retail sector, Mo, is not happy.
Yeah, pretty average update this morning from the warehouse as well. I mean, I don't know that anyone will be surprised. You know, we've had mortgage rates at really elevated levels. That's taking money out of consumer pockets. You know, things are tough out there. The cost of living is higher, whether it's food. Look at your rates. Insurance has gone up 25-30%. So, you know, by the time you get to your discretionary spend, there's not a lot left. And so anybody that's reliant on that discretionary dollar, like your retailers, to some degree that construction sector, right? If you're doing renovations to your house, you're probably on pause at the moment. All of those sectors that are somewhat reliant on a discretionary dollar from the consumer are probably doing it pretty tough. That's what we're seeing in the results. And I think over the next 6 months, it's going to be more of the same. And then as those interest rate cuts start to wash through the economy, people feel like they got a bit more money in their pockets. They feel like the worst of the economy is behind them. And they feel like their jobs are safe. Then you might start to see some spend, and that'll come back into those. I mean, they're called cyclical sectors for a reason, right? They ride the economic cycle, and at the moment, that's not pretty.
Let's be happy now. Okay, let's talk about a bright spot. Mo, bright spot in this report, because I think there's not a lot of them, and most of the companies, were reporting like just sort of flat or losses and bad outlooks out of the 38 that reported. Isn't that right?
I think very few. So it's quite easy to pinpoint exactly where they were. And I want to probably touch on one that Oliver mentioned earlier around Heartland Group. The opposite of that. Turner's Automotive, in that same space, lending into the motor vehicle sector, are scheduled for their 5th consecutive record profit. So, you can do well in a tough market, and that's a really economically sensitive kind of business, selling used cars for the most part, and insurance and those sorts of things into it. But, they're doing remarkably well. They've got a great marketing campaign. They've got a clear strategy, great management team. So I think we should, celebrate and shout out some of those businesses that even in the tough environment, can still make a buck and can still return some pretty good numbers for shareholders. So I would say Turners is the big one, and then the other one I'll just probably point to is Port of Tauranga, local of ours, and they were one of very few companies to put through a profit upgrade. So things going well, and that we should all be pleased with, because think about 40% of our exports go through that port. So if the port is doing well and throughput is strong there, that means New Zealand Inc. is doing reasonably well, at least from an export standpoint.
Okay, Michael, any bright spots for you?
Oh, look, I'll take the easy one. A2,
okay,
up 40% last month. They disappointed the market 6 months ago, and they've delivered this half, with some revenue growth and margin improving as well. That was areas that they sort of disappointed 6 months ago, and they've out-delivered in those areas, and the market's rewarded them.
Is there a theme there, perhaps? Port of Tauranga, not Turners, but Port of Tauranga is export-oriented. A2 is export-oriented. Oliver, is there a theme there for the bright sparks?
Well, I think there's different reasons for those bright spots. And I think some of them are really company-specific factors, and some of them relate to sort of broader macroeconomic themes like export-led recoveries and so on. I think the overall theme, though, it's just a reminder to investors, and this is stating the obvious, right, but strategy matters. And it should be eternal. It should last for a long time. And the road on that strategy may go up and down, but actually, if it's a good strategy, it will endure. And that's what some of those bright spots reflect. Okay. I think PGG Wrightson is interesting.
Okay.
Because actually, you've got, and they're very cautious in terms of a recovery, but that's a great bellwether for a big part of New Zealand in terms of recovery, and that probably reflects where we're at.
So for people who aren't familiar with PGG Wrightson, it's farmer sentiment, is it?
Farmer sentiment, so that's providing services into the rural sector. And I think what you're seeing there is a little bit of more cautiously optimistic outlook in terms of that very key sector. And to some extent, I think also the recovery at Synlait is reflecting that as well.
Okay.
Albeit, I know there's not a lot of liquidity there these days, so that's a different issue. But that still was an interesting bellwether in terms of that rural sector.
Okay.
I think the other bright spot. I think there are a few. You just have to look a bit harder.
But
NZX is interesting to me as a bright spot.
Why
because
is that?
actually you've seen, despite whatever the perceptions are, you saw their markets business, which, the public perception around that may not be that favourable, but actually still increased its earnings by 5% last year, despite a pretty tough year. You're seeing the recovery of its wealth technologies business. So you're seeing some more margin being placed into that, the growth of its funds business. That was pretty much a good news story across the board for investors, and that's reflected in the share price as well.
Okay, let's look forward now. We'd love to have a look at the outlook. I guess the question is, Michael Sherrock, what do investors need to think about for the next 12 months, having just seen this earnings season?
Yeah, it's the timing of a recovery. Is it 12 months? Is it 18 months? How quick do the interest rate cuts flow through to the economy and then company earnings? It doesn't happen immediately, and we're seeing that with the cautious outlook statements. The very few that talk about green shoots or things improving. I do worry that they might be weeds rather than green shoots, and they're not reality. They're something that's better than where we've been, but any real growth, and it really does take time. I am hopeful though, and confident that a lower interest rate environment will flow through to improve spending by the consumer, and then ultimately company earnings as well.
It feels though, this talk of green shoots, a lot of people were saying that at the end of last year, and now you're talking about, maybe the occasional weed amongst the green shoot. It feels like it's been put back a lot, Mo.
Yeah, it's definitely, I think that's been the key thing, is just around that timing.
Yeah.
But I think investors need to remember again, don't get stuck in the now, and that works both ways. If markets are going really strongly, don't just expect them to go up forever. We talk, at length to our clients about that. And at the moment, it's probably on the other side. The New Zealand market feels like it's been tough forever, but don't just sit there and assume and write it off and go, it's just going to be rubbish forever. Like Mike just mentioned, interest rates are going to come down. The property cycle feels like it's stabilising. We are seeing some of those early green shoots. The key thing for a lot of investors is interest rates are falling. So if you've got money tied up in cash, that is going to be working not as hard for you, and the returns are going to be not as attractive. So you have to look forward.
Look elsewhere.
Don't get stuck in today.
NZSA runs an investor sentiment survey. We do that every week. We've done that for years.
Yes.
Right now, what's really interesting about what that investor sentiment survey is telling us is that positive investor sentiment is actually at record levels. So that is a really interesting thing for us to observe, because actually what we are saying is that investors are seeing through whatever the current ills of the market are and going, actually, the future is a little bit more positive than it has been in the past. The fact that it's at record levels, to me, is really interesting, because actually you're seeing there that investors are more certain than not that recovery now it might be late, but it's better late than never, and that is about to come soon.
And probably a lot of your members have diversified portfolios, which means they own US stocks, they own overseas stocks, and actually the US market for the last couple of calendar years has returned over 20%.
It's done very well.
So,
that's right.
While New Zealand's been tough, if you've got a diversified portfolio, you haven't done that poorly at all.
And that is the key message: diversification matters from an investor perspective.
Okay.
I guess, but we've talked about the US. I think that's one theme that I'd like to reflect on as an outlook for the next 12 months, because you do have a situation where you could argue that stocks are pretty fully valued, particularly in the US right now. And so actually how that plays out in the context of a very uncertain political environment. We've all seen the Zelensky-Trump meeting during the weekend here in New Zealand, and that's one word for it. So that uncertainty is a real issue. And the only thing investors can really bank on is that under a Trump presidency, the US market will be consistently inconsistent. So.
I think it goes back to both what Oliver and Mo have said. It's about diversification, because we don't know what's going to happen tomorrow, and so you do need to spread your basket of investment around so that you aren't exposed to one single asset class, one single region, and so when shocks do occur, you're insulated to some degree around that.
All right,
okay. New Zealand's not getting worse, so I think that's where a lot of that optimism comes from. Probably seen the worst, and so think can't get worse any worse from here. So they're improving. We probably see that in consumer and business confidence as well, that they're ticking up. But it's probably more around reflection of where things are today versus yesterday. They're probably looking somewhat better.
All right. Well, given that. I'm just going to quickly ask you if you want to give me sort of a sector or a company without providing any financial advice, obviously, that you're interested in going forward, Mo.
Yeah, I'm going to just jump back to the gentailers that you talked about.
Oh,
Political goldmine at the moment, in terms of beating them up a little bit.
Yeah.
But I think we should sort of, and there'll be a collective eye roll, we should cut them a little bit of slack. I mean, 60% of our generation comes from hydro, from water. So if it's dry, you're going to have these volatile periods. If we want to get to more renewable, whether it's from solar, wind or water, you're going to have some volatility. And at the same time, we've got a gas market that's stuffed, really, right? So you've seen the share prices of those companies come off. They've had disappointing results to what we normally expect, which is just they grind higher every time, right? So I think if you look to the future and go, we are going more renewable, lots of us have to change our habits. 2050, we want to get to net zero. All of those things drive structural change for that sector. And I think any time that sector has a bit of a wobble, I tend to think, geez, that's a good opportunity to buy them on sale for the long term.
Okay. Michael, do you have any particular sector you're interested in?
Real estate actually. So we've seen the interest rate cycle, peak and rates coming down. So valuations have probably finished their decline. So probably seen the worst of that. The listed guys trading at 20% discount to their asset backing. And in a world where cash rates are less attractive, then the yields on offer across those real estate names, around 6%, starts to look pretty attractive.
Okay, all right, and let's wrap this up, Oliver.
So look, at New Zealand Shareholders Association, we just keep an eye on everyone, as every company well knows.
You don't have a favourite child?
We want to make sure that they all do the right thing by their shareholders. And look, we have many favourite children. So look, we think that New Zealand market still is an attractive place to invest, but in the context of a diversified portfolio, and that's really important for investors.
You wish all your progeny well, do you? And that wraps up this episode of the NBR Podcast. Links to social media clips used are in the description. Thanks to content producer Joseph Hisayasu. For early access to new episodes, you can subscribe on Spotify. Or for all the comprehensive business news, grab a 12-month NBR.co.nz subscription this March for just $399. That's $100 off. Up next, the war of words over price hikes and regulation. It's airports versus airlines. I'm Simon Shepherd. We'll catch you then.